I am Jeremiah Ajuda Dusu, the author of JAD's Business and Financial Accounting. I am. Hello, good to see you again. So today we have actually, or let's say for some time now, we've been taking group balance sheet or consolidated balance sheet, okay? So we've taken various aspects or various scenarios from 100% ownership or full ownership, to that has minority interest, and then we looked at pre-acquisition reserves and post-acquisition reserves. And I do hope that you've been following the classes, okay? So we're gradually progressing, okay? So today we're going to take another possible scenario. Of course, in today's class we're looking at, of course, we're still looking at group balance sheet, or what we call consolidated balance sheet. But today we're looking at what we call unrealized profit on inventory. Of course, inventory can also mean what? Stock. Okay? So what we're looking at today, we're looking at a scenario where there is unrealized profit on inventory or on stock. Okay? Now what we're trying to say here is that there is a transaction between the parent company and the subsidiary. Of course, let's say for instance, flour mill. Of course, flour mill acquired Honeywell in recent times. So let's say there's a transaction between flour mill and what? Honeywell. Of course, flour mill is the parent company. Honeywell is the what? Subsidiary. So what we're saying here is that there's a transaction. For some reasons, flour mill might sell his product to Honeywell. Of course, they both deal in flour. So flour mill might sell flour to Honeywell. Of course, Honeywell will what? Buy from flour mill and then sell. Okay, that kind of scenario. So we're saying that the parent company is selling part of his product or part of his inventory or part of his stock to the subsidiary. Of course, in that scenario, the parent company would have also considered his profit margin before selling. So there is a selling price from the perspective of the parent company, and then there is a buying price or a cost price from the perspective of the what? Of the subsidiary. So what we're saying is the parent company, of course, will sell, right? Then the sub will what? Buy. So whatever price that the parent company sells will be what? A cost to what? The subsidiary. So if the parent company sells at, let's say, 10 naira, of course this 10 naira will include the cost to the parent company and the profit to the parent company. So when they sell to this guy here, which is a subsidiary, this 10 naira will be what? Cost to the subsidiary. To parent company to what? Selling price. To sub to what? Cost. Okay? So now what we're saying is that, of course, as long as they are dealing with their various activities separately, it goes on like that. Of course, the subsidiary will also add its own profit to this tenant before selling. Of course, that goes on as long as they are selling. But at the point of consolidation, okay, where you want to now consolidate, you want to bring the parent company balance sheet, infuse the subsidiary balance sheet to the parent company to have one group position. In that case, what we are saying is that the product that has been sold from the parent company to the subsidiary at this selling price, which is a cost price to the subsidiary, we will have to eliminate the profit item that is in this 10 naira because of the fact that the parent company has already included profit to this 10 naira here. So to the parent company, it is what? Selling price. To subsidiary, it is cost price. But because of the consolidation, We are trying to make the subsidiaries balance sheet to be part of the parent company's balance sheet. So in that case, we cannot report, the inventory value at this 10 naira, which is more like a cost to subsidiary, but it's a selling price to the what? To the parent company, because of the fact that this subsidiary, of course, is reporting this 10 naira as cost in the balance sheet. But now that you are trying to infuse the balance sheet into that of the parent company, it can no longer be 10 naira cost. We have to now what? Eliminate the profit item from this 10 naira, because now it is no longer the subsidiary's account, but what? The parent company's account. And don't forget that that inventory was sold at cost plus a profit by the parent company to the what? Subsidiary. So now that we're bringing the account together, so if there's any product that the parent company sold to the subsidiary that is still remaining in stock as at the time we are consolidating, that product that the subsidiary bought from the holding company, we must eliminate the profit element. The profit element that the holding company has on that product before we now what? Consolidate. Because just like saying that what? At that point of consolidation, the subsidiary's balance sheet is now one with the what? Holding company's balance sheet. So that sales, that transaction between the holding company and the subsidiary cannot be reported at selling price, because you cannot be selling to yourself. So we are going to have to remove the profit element. Remember that your stock or your inventory is reported at cost price and not as selling price, because we have the issue of cost being higher than net realizable value. But we're not looking at that now. That will be accounting for inventory, the class for that. But in this case now, we are looking at the fact that our inventory is usually reported at cost, and for that singular fact, and because you're now bringing the balance sheet of the subsidiary into one account with the holding company, that product that the holding company sold to the subsidiary cannot be reported at that price that the holding company sold it to the subsidiary, but it is now selling price. So we must remove the profit so that we can now report it at what? At cost price. So after doing that adjustment, then we can now go ahead to what? To consolidate. So what I'm simply saying is this: remember that asset items debit, liability items credit, expense item is debit, income item is credit. Your inventory, which is your stock or inventory, okay, they have debit balances, okay, assets. But now we want to eliminate the profit item on the stock, so that means there has to be a reduction. So by virtue of reporting the stock at selling price, it means that we have overstated. So we have to bring it down to the cost price. So once we identify the profit element, we remove it. So what do? We credit stock, and then we debit our what? Reserve. Or some people will use profits and what? The profit and loss, or your profit, of course. Your profit is part of your what? Your reserve, okay? So some use profit, some use reserve. So what we are saying here is that how do we now identify the profit element? Of course, it's simple. From the perspective of the subsidiary, there would have been a purchase invoice. So once you go look at the purchase invoice, you will know the cost of the what? Item. So you have to just to remove the cost of the item from the what? Selling price to get the what? Profit. It's that simple. Okay? Of course, don't forget that it is also possible that the sales would have been from the subsidiary to the what? Holding company. So it can be either ways. But if the sales is from the what? Parent company or the holding company to the subsidiary, then you have to adjust the balance sheet of the what? Of the subsidiary to reflect the right value of stock, which is cost, and the right value of what? Of reserve. Of course, if you remove the profit from the stock, then there will have to also be a reduction of the reserve. Okay? But if it's from the perspective of the holding company, you also adjust the stock item and against what? The reserve. It's the same entry: credit stock, debit what? Reserve. So if it is from the perspective of the what? Of the subsidiary, you adjust for it then before you consolidate. If from the perspective of the holding company, you adjust for it before you what? before you consolidate. Of course, in practice, it's easy to identify the profit element, but in this sort of arrangement where it's possible that the reference document is not easily seen, so we look at the profit policy of the organization. Okay, so if we say, okay, for instance, that let's say the holding company sold sold products, okay, worth, let's say, 100 naira to what? The subsidiary, okay. So as at the time that we are actually consolidating, it's possible that they would have sold out of the product. So whatever is remaining, so let's say it is now remaining 10 naira worth of product. 10 naira worth of what? Of product in the book, or let's say in the balance sheet of the what? Sub. Of course, there can be other products, but that part, the one that the holding company sold, 100 naira. But as when we were consolidating, the balance sheet is saying that out of the one that the holding company sold to the subsidiary, only 10 naira is remaining. Okay? Don't forget that from the perspective of the holding company, it is selling price, but to the subsidiary, it is what? Cost. So they would have reported that product as cost from their perspective, but from the perspective of this company that is selling, which is the holding company, it is selling price. But now they are bringing their what? Balance sheet to be one. Of course, you have to now return this 10 naira back to what? Cost price. Okay? But now that we're saying the referencing document is, it's not easy to get. Where we can easily say, okay, this is the cost. Then once you take the cost from the second, I'll get the profit. It's not easy in practice. But now let's assume that we can even get the word reference document. So how do we get the profit? And because fine, what is the profit policy? Let's now say that the holding company maintains a profit policy of 25% on cost. So that means that what? This 10 naira has what? The cost price of the product plus 25%. So what do we do? With our simple mathematics, we can say that the cost plus the profit is equal to what? The selling price, right? We have the selling price to be 10 naira. So that's 10 naira. So this is the cost, but we don't even know the profit. Profit is what? 25% of the cost. So that will be plus what? 0.25C equals to 10 naira. So this is like 1C plus 0.25C. So that will be 1.25C equal to what? 10 naira. So how do we get the cost price? That will divide both sides by 1.5. So if you go 1.25, so this, we can see this. C will be equal to 10 divided by 1.25. So when you do 10 by 1.25, you'll be getting 8 naira. So that means the cost price is what? 8 naira. So now that we have the cost price, what is now the profit element? So the profit will be what? Selling price minus cost price. Selling price is 10 naira, cost price is 8 naira. Profit is what? 2 naira. So we are going to adjust or raise journals to adjust this profit element against the stock. So it means that what? We credit stock with what? 2 naira. Debit, we credit stock with what? 2 naira. Debit what? Reserve with what? 2 naira. So it means that what? Before we consolidate, we must adjust the what? Balance sheet of the what? Subsidiary in reference to stock and what? Reserve by 2 naira. So stock will reduce by 2 naira, reserve will reduce by 2 naira before we now proceed to do our consolidation. Of course, which is what we've been doing. If it is full ownership, you go the direction of full ownership. If it is what you call partly owned, where you have minority interest, go in that direction. I've already taught the class on that. So it's the same, every other thing remains the same. The moment you adjust the balance sheet and you now get the revised balance sheet, you can go ahead and do your consolidation. That is my own approach. Before you even consolidate, make sure you adjust what? The balance sheet items to reflect what it should be after the adjustment before you even proceed to what? Consolidate. So you can go ahead and raise your normal journal if you're using double entry approach. Open your investment account, open your reserve, open your minority interest, open your what? Your consolidated reserve. Post as usual. I've taught you that. You can take the class. I believe that you'll be following up. So I don't advise you to jump class. go and follow up from the beginning and then see how we're doing it. So every other thing I've taught is relevant. Here, I'm only telling you or helping us understand how to adjust for what unrealized profit on inventory. So once you get that profit element that you need to adjust for, once you eliminate it, you get a revised value, you can then go ahead and do your what? Consolidation. Open your various T's, take your entries, and then go ahead and prepare your consolidated what? Balance sheet. I do not think that I should start opening it because I've done that in a video class, so you understand that already. So I just go straight to what? Using the consolidation schedule to what? Illustrate what we're saying. All right, let's quickly take this question so we understand exactly what we are talking about here. Okay, I have an idea of where we are actually going to here. Okay, so the question says the following represent the balance sheet of Kings Limited and Queens Limited as at 2018. So we have all the items there: land and building, furniture and features, debtors, investments in Queens, inventory. Then we have cash at bank, and then we have share capital and reserve. Then they say Kings Limited acquired 90% shares in Queens Limited on 2016 when its reserve was 1,150,000. Okay, now the inventory of Kings Limited includes inventory worth 2 million naira purchased from Kings Limited. It is the policy of Kings Limited to sell at a profit of 20% on cost. Prepared consolidation schedule and conduct what statement of financial position at 2018. So this question here, is going to help us understand how to treat unrealized what profit on what inventory. So we already have the balance sheet. And look at it, we have the balance sheet of what? Of kings and queens. Okay, so let's go. What do we have there? So we call this consolidated what? Schedule, right? So here we have cost of what? Control, which is kings in queen. That's 90%. Okay, so here we have minority interest, which is 10%, right? 10%. And then here we have consolidated E and L. So first thing first, we have Queen's share capital. I think that one is how much? 100 million. So that's 100,000. So we have 90% of this. That's 19,000. Then 10% here will be what? 10,000. Right? Okay. So the next one now is reserve. The reserve here, according to the balance sheet, is what? 21,150. But before we even look at this, because there's an inventory adjustment, so that will affect the reserve. Of course, if you remember our adjustment, yes, an unrealized profit from this. They said that the inventory of Kings Limited includes inventory worth 2 million purchased from Kings Limited. It is the policy of Kings Limited to sell at a profit of 20% on cost. So if you look at the balance sheet, you will see that the inventory of Queens is 12 million, but there's a 2 million worth of product that they purchased from Kings. So for the consolidation purpose now, of course, if they purchased it from Kings, Kings are sold at a profit already. So what they are reporting as cost from Queen's perspective is actually selling price from King's perspective. So because of the consolidation, we have to adjust for that profit element before we consolidate. So what do? We know that what? We know that that here we know that the cost price plus profit is equal to selling price. So the cost we don't know. Profit is 20%, according to the question. 20% of the cost. So that will be plus 0.2 C. That will be equal to what? What is our selling price? They said that the product is worth 2 million. That's 2,000. So that means that this is 1 C, but that will be 1.2 C is equal to what? 2,000. So C will be 2,000 divided by 1.2. So what's our cost price? So let's go use the calculator. Okay. So what do we have here? That's 2,000 divided by what you just say divided by that's divided by what? 1. Okay. Excuse me. So you can just say 2,000 divided by 1. Excuse me. 0.2. So we have 166. So this is cost. 2,000 divided by 1.2 is 166. Approximately 1667. So if cost is 1667, then what is now our profit? So profit will be equal to selling price minus cost price. So that will be 2,000 minus 1667. Okay. So what do we do? See, $2,000 so that minus 1667. So what do we have? This profit is equal to 333. So this is what we're going to adjust. So we say debit what? Stock 333. Credit was reserve 333. Okay. So if you open our ledger here, you open stock of the subsidiary. What's the stock of the subsidiary there? The stock inventory there is what? 12,000. So balance brought forward is 12,000. So we adjust, okay, unrealized profit of what? 333. So what's the new balance? We have 11667. 11667. So when you add up, you have 12,000. You have 12,000. So our new inventory balance was 11667. So our reserve too. Let's go. So what's the balance brought forward? According to the question, our reserve is what? 21,150. 21,150. So let's adjust unrealized profit 333. Can you see that? So we have 21,150 minus 333. What do we have? 2817. So carry on of 28,170. So when you add up 21,150, 21,150, but there's a new value there, 28,170. So this is the new reserve. So our reserve here now will be 28,170. But remember, there's a way we adjust, right? We have 28,170. We have pre, we have what? Post. So what's the pre? According to the question, it said that Kings Limited acquired 90% of shares in Queen Limited when its reserve was 1,150 million. So pre is 1,150. So when you minus that, so this post will be what? 19,667. Okay. So what do we do now? Minority interest is 10%. So 10% of this, let's move. Of 28,170. What do we have? 2081 approximately. 2081. So here we have 2081. 90% of the pre. What do you have? What is the pre? 1150. Sorry, this is 2081 minority. This one is 1035. So we have 1035 for the pre. So what's the posts? The post is 0.9 times, what do you have there? 19,667. What do you have? 17,700. That's 0.3. 17,700 approximately. Okay, we have 17,700. Okay, so if you know, of course, we have approximations there. Okay, so if you add up 17,700 plus 2081 plus 103, excuse me, 3, 5. What do we have there? That's 20,816 point. Okay, so there's an approximation here. This is 0.3. Okay, so this is approximately 0.816.7. So approximately is 20817. Okay, so we have approximation there. So if we want to just, since there's a point here, there's a point here, so let's approximate one. Of course, in financial accounting, approximation is not really around, but you understand that it's approximation. So we have 2817 when you add up because of approximation there. So we now have 1035 plus 2081 plus 1770. That will give us, there's a 0.3 here, there's another point here, there's another point here. When you look at it, you add up those points, okay? Or better still, let's put them as they are, so we don't make mistake. This is point, okay? This is 0.7. This is 0.7, this is 0.3. Okay, so let's say 0.7, 0.3. So if you add up, two 081.7 plus 17,700.3 plus 1035. So we have 2081 there. So that's it for that. The next one here is what now? For us to get the net asset acquired. Okay? So what's the net asset acquired now? Let's add up this. So we have 53019. So this is 7.18021. Okay? So this is your net asset acquired. So we have investment. What's the investment? Is 130,000. So what do we have? We have 130,000 minus 91035. What do we have there? So we have 38965. This is your goodwill on consolidation. This is your net. This is your net asset acquired. So this is your goodwill on consolidation. Okay. So here, the minority interest is 12081.7. Okay. Then we now bring out our what? King's reserve. What's the reserve according to King's? 104,500. We have 104,500. So we add up. So this will go to your what? Consolidated balance sheet, right? So what do we have? We have 104,500 plus we have 17700.3. So what do you have? We have 122,200.3. Okay, so this is what we have. So let's prepare. Say now, what do we say? We say King's and its what? Subsidiary. So we say statement of financial position as at 31st December 2018. Okay. So we have assets. Let's call this notes. Okay. So non-current. Let's call that note 1. What's note 1 here? What are the non-current assets? Land and building and fixture and fittings. So we have land and buildings. What do we have there? Holding company is 60,000, subsidiary is 40,000. So we have 60,000 plus 40,000. So what do you have? 100,000. Okay, the next one is furniture and fittings. So what do we have there? We have 40,000, 25,500. So that will be what? 65,500. So this is 165,500. 165,500, right? So the next one now is your what? Current. Note 2. So let's call that note 2. Note 2 here, what do we have? We have debtors. So what do we have for debtors? 20,000 plus 15,000. We have 20,000 plus 15,000. So what do we have? 35,000. Right? The next one, inventory. That's the stock. Holding company stock is 20,000, but that of subsidiary has changed. So we have 20,000 plus what do you have there? 11,667. 11,667. So what do you have? That will be 31,667. Right? So what's the next one? We have the bank. What's our bank there? Bank is 34,500 plus 28,650 plus 28,650. So what do you have? Like 20,000 plus 11,667. That's 167. Okay. 34,500 plus 28,650. 63150. 63150. Add everything up plus 63150 plus 35,000 plus 31667. We have 129817. We have 129817. So what's our goodwill? The debit balance, we test it. That's 8965. That's 8965. So what else? That's also when you add up. So that asset here, what do you have? Plus 165,500 plus 3,896. Excuse me. 65. This is 334,282. 334,282. So let's go liabilities now. What do we have? Let's do what have we have? 122,200. 122,200.3. So what else? Minority, or let's say our share capital. What's our share capital? Share capital here is 200,000. So what's our minority interest? 12081.7. 12081.7. So let's add up. So we have 122,200.3 plus 200,000 plus 12081.7. So we have the 334,282. This is your total asset, this is your total liabilities. Okay, so what we've done here basically is to prepare consolidated balance sheet using the consolidated schedule, okay, to account for a scenario that is unrealized profit, for which is transaction between holding company and subsidiary, can go either way as well. Okay, how we've been able to do so, you can see the illustration here. How we're able to get profits, how we eliminated it from the stock and from the reserve before we now prepare the consolidated schedule and then the consolidated balance sheet. Okay, so if you have questions, you can reach me on the numbers displayed. I'll bet you reply with the right answer. Don't forget, you can support us by paying to the account numbers displayed or sponsor copies of my textbook for free distribution. Thank you.